houses have appreciated 15% in 3 months, 50% year over year in some market. Are we in a bubble?
So I think that there's a difference between a bubble versus fundamental supply and demand. So what happened in 2009 was the government did a mass amount of foreclosures and flooded the supply when demand was staying constant. Increased supply, demand stays constant means prices are going to drop, right?
Right.
Today, we actually have quite the opposite. And what's actually so interesting, Jason, is, I've raised 4 rounds of capital at this point. Every investor, when I was raising, every venture capitalist asked me, they said, what happens if home prices decline, right? What is Divvy going to do? Not one venture capitalist asked me, what do you do when home prices skyrocket and inventory becomes tighter? And so that's just a lesson in the unknown unknowns, which is,
or just how the venture mind thinks, right? There's they're like, I have a chance to ask the founder a question. I should ask them about what happens if the Titanic hits an iceberg. Because it's actually not as much about, and I know you spent some time in venture, it's not as much about they actually care about the answer to that question as they care about how thoughtful you are in answering it.
Yes. Yes. And I understand that. I think
the answer for you would be, well, if you're raising the price 3% and the home's gone down 20% in value, now the person's underwater and they're demotivated, but you can always correct that. Right. Well,
in those situations, we're sitting on a cash flow stream. So we make enough profit that we can sustain some hit in price. So we can basically sustain, call it a 15% hit in prices and still break even on the property and we're fine. And then in that case where the customer's underwater, we'd extend their lease. We'd let them stay in the house longer, build more equity, and then buy back the house when the time is right.
These are not $20 million. These are not $20, $30 million houses that people overpaid $5 or $10 million for. That would be a whole different ball game. These are houses people need in a housing shortage. So are we you don't believe we're in a bubble. So let's unpack why we're not in a bubble in your mind.
Yes. So what we're seeing today is that COVID causes very interesting market change, right? Where all of a sudden, no one wanted to sell their homes because no one wanted to move during a global pandemic. So supply, you can say it stayed constant to slightly decrease. There are just less existing home sales. So you have a case in which supply is not growing. And at the same time, demand started to spike. Why did demand spike? Well, because everyone was living in their studio apartment was, like, hey, it'd be great if I bought a single family home that had a backyard, right? And some place for me to actually spend some time outside. And so what we did was we actually saw demand go up. Now, this was even more impacted by the fact that people who would have typically sold actually had the opportunity to refinance. Right? They refinanced their mortgages because rates were really low, which kept them in their houses even longer. So supply was even impacted more. So you have demand going up, supply going down. And the result of this is that home prices have started to rise. Right? And that is a lack of inventory. Now, how does that correct itself in the market? One, you can add more supply. I don't know how many folks, realize, but it takes 5+ years to build a home. Right? It just doesn't go up overnight. Why? Because the government puts in titling and you have to make sure that
the NIMBY issues in some places.
Yes, but that's for affordable housing. But yes. But point being that it just takes a long time for new build homes, right? And so you're not going to flood the market with supply suddenly. And given the way that work is moving to be more remote, I actually think that demand is going to only continue to sustain. So given that, I actually think that home prices are going to continue to increase. And I think that we've entered just a fundamentally different time where remote work is going to be more acceptable. And that we're just undersupplied on single family homes, which, by the way, was an issue even before COVID, but was exacerbated by COVID.
Is there an issue right now where people are moving into a kind of YOLO moment and they look at the house they're in and they're going and buying a second house somewhere because they don't have to go to an office? And I'm talking about a slightly higher end of the market, but I think it's now becoming a trend where people are like, I left Brooklyn and I now have a place in Florida or Nashville, but I decided to not sell my place in Brooklyn. Or I was in San Francisco or Palo Alto. I'm going to keep my place there, but I moved to, Park City because I want to ski and I can. So are there a lot of people now where they're owning more than one home and not selling the original one? Because let's face it, if this is a better asset than the stock market is, which I think a lot of people feel this might be a better asset than the stock market, which feels bubbly, now that's going to constrain supply even more. Is that a trend Or is that just anecdotes that I'm seeing near me because I hang out with a certain group of people?
You definitely hang out with a certain group of people.
Okay.
I definitely don't know that as that area, the second home market as well, because transparently, our customers are struggling to buy their first home. I think that if anything, Jason, that's more a factor of lower interest rates, right? If you could refinance out your Brooklyn apartment at 2.5%, why sell it, right? I mean, that's pretty cheap, right? To be able to keep it. Now, if interest rates increase, you have a 5/1 adjustable rate mortgage. Interest rates increase in 5 years, maybe that's something then that you would consider selling. Because if you were paying 6% on that mortgage, even 5% on that mortgage, right? All of a sudden, maybe you wouldn't be keeping it as easily.
Right, because you wouldn't be able to rent it for as much as your carrying costs. Now you're screwed. Okay, now you have folks like BlackRock buying up thousands of homes, reportedly, and sitting on them maybe, or renting. I'm not sure what they're actually doing. That's always existed, but it seems to be increasing. There was this big Wall Street Journal article about that. Is that reality? And is that causing problems? And if so, in which parts of the market?
Yeah, so we're seeing, we call this like institutional investors. We're seeing institutional buyers increase the pace at which they're buying assets. Why? Because there's no yield. You're not getting returns across the market. And so they're turning to actually homes, which are one, appreciating extremely fast. But then two, you can rent them out and still make a pretty good return versus what you can get on maybe a bond or some other asset class that you would put your money into. So we are seeing a massive influx of institutional capital into the single family rental market. Now, on the positive side, I think that for our customers, what's nice about that is when Divvy goes to bid on a home, we're bidding on behalf of them. So we'll say, hey, Jason, we think we should bid $350,000 for this house. And you might say, hey, Dina, I actually know the market. It's really hot. I think you guys are bidding too low. Maybe we should go to 355. Or maybe you'll say, hey, you guys are bidding too high. Let's go to 345. Now we have a range that we allow, but within that range, we have a conversation. We decide on the bidding strategy and we will go out and bid for you. You are going to get an all cash offer that's going to have generally anywhere from 0 to 5 day due diligence period. We'll close within 2 weeks for you. And you just became as competitive as Blackstone when Blackstone goes to bid, right? So what we do is we take the average consumer and we make it so that they can actually compete with the BlackRocks, Blackstones, Invitation Homes of the world, because we offer as competitive of an offer that they couldn't do even if they had a conventional mortgage.
Today, many small business owners are busier than ever. Since they're focused on managing and growing their business, they can't always spend the time they wish they could on recruiting, and you're only as good as your team. I talk about that all the time on this podcast, and that's why LinkedIn Jobs has made it easier to find and hire the best candidates for free. Get started by posting your job for free to reach LinkedIn's network of 740 million professionals. Oh my God, there's a lot of people on LinkedIn. Fill out targeted screening questions to get your role in front of the most qualified candidates with the experience, skills, and motivation you need. Then it's easy to filter and prioritize the top candidates you'd like to interview. We love LinkedIn Jobs at launch and at Inside. We've hired a second producer, a curriculum designer, and a few more researchers. We are crushing it. We're now 18 people here. I can't believe it. It used to be me and like 3 people. Every week, nearly 40 million job seekers visit LinkedIn. If you've got a job, you're going to find those job seekers on LinkedIn, and they're going to find that right person for your role right now. Don't waste time. Post your first job for free. That's right, free. LinkedIn is so supportive of this podcast that they're going to let you post your first job for free to prove to you how amazing their product is. That's how confident they are. LinkedIn.com/unicorn. That's LinkedIn.com/unicorn to post your first job listing for free. Of course, terms and conditions do apply because they're giving you that free job posting.